Since its recent pullback, Meta Platforms is already up more than 20%, and it's not just one factor driving the move. The company did launch its latest AI model after delaying it just a few weeks ago, reigniting optimism around its long-term growth story.
Yes, we have the news, Scott. Meta launching its long-awaited new AI model called Muse Spark. This was originally codenamed Avocado. It's launching on the Meta AI app and website today, rolling out to its other apps and AI glasses in coming weeks.
But at the same time, broader market sentiment also improved, with easing geopolitical tensions, particularly between the US and Iran, helping support a broader risk-on move in equities. So this isn't happening in isolation. AI is back in focus. Macro conditions are improving and investors are once again turning bullish. But here's the real question. Is this momentum actually justified, or is the market getting ahead of itself? So, what is the main concern for Meta investors right now? It's the massive AI spending. Meta plans to spend between $115 and $135 billion this year on AI infrastructure. The issue is that costs are rising much faster than revenue. In the last quarter, expenses grew 48% while revenue grew only 24%. This has investors worried about squeezed margins and free cash flow in the short term. The big question everyone is asking, will this huge AI bet pay off or become another expensive failure like the metaverse? Despite this aggressive spending, Meta is still fully funding its AI investments with its own operating cash flow. In 2025, the company generated $115 billion in operating cash flow, while CapEx was only $72.2 billion. This means they are financing everything internally without heavy debt. That's a very strong sign of cash generation power. And even with all this CapEx, Meta's core margins remain at elite levels. Gross profit margin stays above 80%, operating margin is strong around 40%, and net profit margin continues to be excellent. The only margin that has clearly suffered is the free cash flow margin, and that's purely due to the massive AI infrastructure investments. The underlying business is still extremely profitable and efficient. Another impressive metric is Meta's return on invested capital. Even after years of heavy spending, Meta delivered excellent returns. It peaked near 49% in 2018, dropped during the metaverse years, but has recovered strongly. In 2025, ROIC stood at 28.5%, still very high for a company of this size. This proves Meta continues to generate strong returns on every dollar it invests. Finally, Meta's greatest strength is its massive economic moat. With over 3.58 billion daily active users across Facebook, Instagram, WhatsApp, and Messenger, the company has built one of the widest moats in tech. The network effects are incredibly powerful. People stay because their friends and family are there, and advertisers follow the users. Combined with Meta's huge data advantage and advanced AI recommendation systems, its advertising platform is extremely effective and very hard to replicate. This gives Meta significant pricing power and long-term durability. Let's look at Meta's growth outlook. According to analysts, Meta is expected to deliver 21.6% forward revenue growth, which is very impressive for a company already doing $200 billion in revenue. On the bottom line, forward EPS growth is more moderate at around 12.9%, mainly due to the heavy AI investments we talked about earlier. However, the really exciting part is the long-term outlook. Analysts forecast a 22.4% EPS CAGR over the next 3 to 5 years. That's a very strong growth profile. Before jumping into the DCF, let's take a quick look at how the market is valuing Meta Platforms today. If we look at the price-to-earnings ratio, Meta has historically traded at an average PE of around 25 over the past 5 years. Right now, the stock is trading closer to 26.9, which means investors are paying a slight premium compared to its historical average. Now, if we shift to the forward PE, the picture looks a bit different over the past 5 years. Meta's average forward PE has been around 21.7, while today it's sitting closer to 21. So, on a forward basis, the stock actually looks more fairly valued, or even slightly cheaper. So, what does this tell us? Based purely on market multiples, Meta doesn't look like a clear bargain. If anything, on a trailing basis, investors are paying a small premium relative to history. But at the same time, we have to consider the context. This is still a company expected to grow revenue at around 20% annually over the next couple of years, while maintaining very strong profitability. So it's not obviously cheap, but it's not clearly expensive either, which is exactly why we need a deeper valuation. So now let's get to the DCF based on my assumptions around revenue growth, margins, and long-term reinvestment. I ran a full discounted cash flow model to estimate what Meta Platforms is actually worth today. In my base case, I get a fair value of around $720 per share. In a more optimistic scenario where growth remains strong and margins continue expanding, the valuation goes as high as $1,435. But in a downside case, assuming slower growth and more pressure on profitability, the fair value drops to around $238. Putting all of that together, my probability-weighted target price comes out to roughly $803 per share, which implies about a 26% upside from the current price, suggesting that Meta may still be significantly undervalued. To cross-check the valuation, I also used an EV to EBITDA exit multiple approach. Here, I assumed a 16x multiple in the base case, 20x in the bull case, and 12x in the bear case. In the base case, the implied price is around $1,118 per share. In the bull case, it goes up to $1,654. And even in the bear case, the valuation still comes in at around $655. That leads to a weighted target price of approximately $1,159 per share, which translates into roughly a 12% annual return from current levels. So across both methods, the conclusion is fairly consistent. Based on my assumptions, Meta appears to be undervalued. Now, to take this a step further, I ran a sensitivity analysis. For the multiple, I used a PE of 25 in the base case, in line with Meta's historical average. In the bull case, I assumed 30, and in the bear case, 20. For earnings growth, I modeled 20% annually in the base case, broadly in line with analyst expectations. In the bull case, I used 23%, and in the bear case, 17%. I also assumed a required return of 15% over 5 years, along with a 10% margin of safety. Based on these assumptions, the base case gives me an entry price of around $653 per share. In the bull case, that entry price moves up to about $887. And in the bear case, it drops to roughly $460. So with the stock currently trading at around $630, it's actually below my base case entry price, which means that, under these assumptions, the expected return is likely higher than 15%. And when I weight these scenarios together, I get an average entry price of around $673 per share, which still suggests that Meta may offer attractive returns from current levels. If we look at the sensitivity table, I'm assuming EPS growth ranging from 15% up to 24%. But I'll mainly focus around the 20% level, which is broadly in line with analyst expectations. And then I vary the valuation multiple from 18 on the low end to 27 on the high end. Even in a more conservative case, assuming a 18x multiple, which is a pretty stretched downside scenario, the 5-year compound annual return still comes in at around 11%. And that's already quite interesting, because even in a relatively weak valuation environment, you're still slightly outperforming the broader market. If we move closer to a 24x multiple, the expected return increases to around 17.5% annually. And if the multiple stays roughly where it is today, you're looking at close to a 20% annual return over 5 years, which effectively means more than doubling your money. So across a wide range of scenarios, the return profile here remains consistently attractive. So to wrap everything up, Meta Platforms is clearly a very high-quality compounder with strong revenue expectations and a solid long-term growth profile. And even though the stock is trading at a fairly solid market multiple, it still looks undervalued. Both the discounted cash flow model and the sensitivity analysis point in the same direction, that the stock can still deliver very attractive long-term returns from here. So across different scenarios, we consistently see strong upside potential with return profiles that are well above market averages. And personally, I believe that anything below $650 is an extremely attractive entry point for Meta. To me, that level is what I would call a screaming buy zone, based on the fundamentals, growth outlook, and valuation framework we just went through. But of course, the key question is whether those assumptions actually play out. If you enjoyed this analysis, make sure to leave a like, subscribe for more deep dive stock breakdowns, and let me know in the comments what company I should cover next. And I'll see you in the next one.